Okay, now we're going to look a little deeper at generally accepted accounting principles. These are going to be the rules that we have to follow to make sure that we have these financial statements that we talked about last time. That's what GAAP is, or those are the rules that we follow. One thing I wanted to mention, they are prepared by the Financial Accounting Standards Board, right? That's who prepares these generally accepted accounting principles. You also have to keep in mind that as we move to a more global world, the international piece is taking on a bigger role. So there's something equivalent in the international world called the International Financial Reporting Standards. It's pretty close to GAAP. What we're going to learn is GAAP, but you will also understand most of the things that go into the international pieces as well. Next thing we're going to talk about is the rules that make this up, right? This is some of just the foundational things. If you look at this slide, this is in your book, right? And I know that you probably can't read all of it, but that's okay. We're looking at the rules that make up generally accepted accounting principles. Those rules are comprised of principles, assumptions, and constraints, right? That's what we need to know. There are general principles and specific principles, and we're not going to stress too much about that. But we're going to go through and we're going to talk about all of these different things, these principles, these assumptions, and these constraints. Remember, they are the foundations of generally accepted accounting principles, right? So, the first principle that we talk about is called the measurement principle or cost principle. You'll hear me say the word cost principle most often. All this really means is that we record things in our accounting records at what we paid for them, right? So if I have a piece of land and the asking price is $100,000 and it's appraised at $80,000 and I offer him $60,000, but we agree on 70 and 70 is what I pay him, none of those other numbers matter, right? It's just the $70,000 that we paid him. So all it means is we record things at cost and we don't change that cost, right? That's one of the basic principles in accounting. There are times we'll kind of skirt around the edges as we go through the rest of the quarter, but we'll always talk about how that relates back to this cost principle, right? The next one that we look at is the revenue recognition principle. That just means that we recognize revenue when we earn it, not when we get the cash, right? So if we go out and do work and somebody owes us money, right, that's accounts receivable when someone owes us money. So I don't have to receive the cash. I'm still going to recognize that I earned that money. So revenue recognition, all it is it's as simple as that number one bullet point there, right? Recognize revenue when it's earned. Okay. This next one's important. The expense recognition principle or the matching principle. Simply said, a company must record expenses incurred to generate the revenue recorded. So this means that we match expenses to the period that we earn the revenue, right? We record revenue when it's earned based under this revenue recognition principle. And then I match the expenses I use to earn that money against that particular revenue, right? So I match that revenue or that expense to the period that it earned or that the revenue was earned, right? So that's what the matching principle talks about. And again, I'm going to say the word matching principle more often than the expense recognition principle. That's kind of how I learned it and how I've always talked about it. Full disclosure principle is really simple. It just means that the accountant has to disclose anything that's going to impact the financial statements users' decisions, right? And we talk a lot about this when we get into some of the more advanced topics and how we communicate some of the more detailed information. So that will come up again. But I really want you to get these under your belt, those first three, the cost principle, the revenue recognition principle, and the matching principle, right? That is an important piece of business. Okay? Now, we have some assumptions that we make also, right? These are all part of generally accepted accounting principles. We assume that a business goes on in perpetuity, that it continues to operate and will continue to operate for as long as the world exists, right? So we assume it's a going concern. Monetary unit assumption is pretty simple. It means that when you measure things, you have to have a yardstick, right? And for us, the yardstick is the dollar, right? That is our monetary unit. That's how we measure things. Now, that's not a perfect measurement, right? Because a dollar is different now than it was in 1950 or whatever, but we account for that. We understand that that our yardstick is measured by dollars, right? Now, this business entity concept, this is a little tricky. legally, the owner and the business are one person, right? But from an accounting standpoint, the owner is separate from the business. They are two separate economic entities, right? So you have the owner and the business, right? We draw a line between them that says they are two separate economic entities, right? They may interact. The owner might take money and put it into the business, and when the business earns money, he may take some out, right? But when we do the accounting, we're doing the accounting for the business, right? For the business. Now, this is important also. Time period assumptions. So we are busting the world into little bits of times, like months and years, right? So we report things generally for a specific period of time. So we always want to make sure that we state that time period, and when we get looking at financial statements, that will become a little more clear to us, right?